This is Chapter 8, Investments. What does it mean to invest, or what is investing? Basically, it's an asset or an item that is purchased with the hope that it will generate income or appreciate in the future. When a business or a person decides they want to invest, they need to look at certain criteria. And not only just look at this criteria, but also evaluate these criteria. These criteria are risk, return on investment, and the person's timeline, so their time frame, the period that they have to invest. When we're looking at risk, we can say that a high-risk investment option could lead to a higher return only if that investment succeeds. Otherwise, it could lead to a big loss. So that means that when we are looking at investment, we need to look at a way in which we can reduce our risk. And a way in which we can do that is through diversification. Diversification is when you split your investment options. And so this is where that saying of don't keep all your eggs in one basket comes into play. What you're trying to do is you're trying to have a combination of different investment options so that you can spread the risk, and that means that there's that risk of big loss. An investor also has the option to choose the degree of risk relative to the most suitable investment option for him or her at that particular point in time. Now remember, it's the same when a business wants to invest. When we are looking at return on an investment, this is basically seeing how much will the investor get back over and above the original amount that was invested. You obviously want your investment to increase in value. Therefore, you want your return to be higher than the original amount that was put into the investment. When we are looking at the time frame, this is where we are looking at how long or how many years does the investor want to invest their money for. When we are looking at all three of these together, we could say that if the time frame is quite long, for example 40, 50 years, then the person could actually take out an investment option that has a greater risk because it's got many years to recuperate any losses, and therefore they're able to make a good return on their investment. As an investor, there's many different investment strategies that can be put in place. And we're going to be looking at growth strategy, balance strategy, defensive strategy, and conservative strategy. The first one that we'll be looking at is the growth strategy. Now, the growth strategy is a high-risk strategy. This emphasis is on long-term capital growth as opposed to monthly income. And therefore, this links quite closely with shares being your investment option. There will be other investment options that you can see later on when we go through them that would fall under this growth strategy. But for now, you know that shares will fall under this strategy. There's a way in which one can reduce the risk involved in this strategy, and that is by purchasing blue chip shares. And a reason for that is because blue chip shares are seen to be the most solid companies on the stock exchange. And this usually means that they have large market values and a steady growth pattern in their share value, which translates to the fact that their share value could increase steadily, and so therefore you can get that return. The next strategy to look at is the balanced strategy. This is some sort of medium risk. The aim is to have capital growth, however, there is some monthly income as well. And so therefore, this is a combination of equities, which we know is the same as saying shares, plus interest-bearing investments like fixed deposits or investment in property where you can get some monthly rental income. So here you could look at possibly having a property that has a granny flat attached to it, and therefore you're getting some of that income on the side. The next strategy that we will be looking at is the defensive strategy. The defensive strategy's aim is to have very low risk. The emphasis is on monthly income with some capital growth. And so therefore, you're investing in a property where you purchase a property in a good location, you rent it out, and you can get that monthly income from renting out the property. There could be money in the bank or even smaller investment options. And so therefore, having that money in the bank, you can then get that little bit of interest income every month. The conservative strategy is where you want very limited risk. As you know, there will always be risk involved in investments, and so therefore you want limited risk. The focus here is to have monthly income as well as some capital growth. So what you're doing is you are ensuring that you are maintaining capital growth as well as having monthly income. And so that means you would have property, for example, where you can generate a monthly income and it would also increase in value over time. So you probably buy a property in a very upmarket area or an up and coming area that's going to increase in value over time, and then you rent it out. And so therefore you know that you're going to get that capital growth as well as monthly income. You could also invest your money in cash instruments such as a fixed deposit where you know the risk is very limited there and you're going to get that monthly income of your interest. And then of course you could obviously get capital growth, but it's never going to beat inflation. Throughout investments, we are going to be looking at different investments different investment options that are available. We're going to be looking at shares and equities, or even known as stocks. We're going to look at debentures, also known as bonds. We're going to be looking at retirement annuities and pension funds. We're going to be looking at endowments. We're going to be looking at offshore investments, unit trusts, collectibles, notice deposits, and fixed property. Some of these we have already discussed in grade 11, and so some of them will just be recapping, but some of them will also be completely new.